Those who take the first step are usually smart investors. While newspapers were announcing wealth and financial freedom, while politicians were promising economic growth, some people had already slipped out through the back door. They see the ship taking on water before it sinks. They see the sparks and the first smoke before the fire spreads everywhere. And in those few hours before chaos erupts, while everyone else turns a deaf ear to the warnings, they get meticulously to work. The situation was the same on October 28th and 29th, 1929. While millions of Americans were dreaming dreams they would never be able to realize, those who truly understood the game were taking steps that would shape the next 10 years. The real question was not whether chaos and collapse would come. The real question was whether the insiders knew it was coming, and what steps they took the moment they learned. While ordinary investors were still waiting for dreams to come true, the Roaring '20s had kept America awake more than any other decade before it. Stock prices seemed to take flight. When prices were at 50, they reached 100. When they were 100, they reached 300. Radio companies, automobile manufacturers, and consumer goods firms saw their shares soar month after month. Ordinary Americans who had never owned a stock before were going into debt to buy shares. Taxi drivers were handing out Warren Buffett-style stock tips. Street vendors were debating market trends. Everyone believed the rise, the stock price explosions, would never end. Yet beneath the boom, experienced investors who truly understood the system were following very different paths. The head of America's most famous political dynasty, Joseph Kennedy, was already prepared months before disaster struck. While inexperienced investors were celebrating record highs, Kennedy had quietly begun selling his shares throughout 1929. According to legend, he decided to exit the market after even a shoeshine boy started talking to him about stocks. But the truth was far more calculated. Kennedy understood leverage better than almost anyone. When everyone was lining up to borrow money to buy stocks, he knew the system had turned into a casino. Even a single strong gust of wind could trigger a storm. By late October, Kennedy had not only exited the market, he was also betting against it. Another legendary financier, Bernard Baruch, who had advised presidents and made fortunes during earlier upheavals, was also reducing his positions throughout the summer of 1929. Baruch had lived through the panic of 1907. He recognized the warning signs. When speculation reaches its peak, when everyone is leveraged, when everyone believes prices can only go up, that is precisely when markets prepare to collapse. Baruch later wrote that he could feel danger in the very atmosphere of Wall Street. The conversations, the confidence, the reckless optimism, it all reminded him of previous crashes. By October, Baruch had converted most of his portfolio into cash and government bonds. He was ready, but it wasn't only individual investors sensing trouble. The Federal Reserve, America's central bank, spent 1929 tightening credit in an attempt to curb what it saw as dangerous speculation. Interest rates were raised from 5% to 6%. For those paying attention, the message was clear: easy money was coming to an end. When central banks stop inflating a bubble, the bubble begins to deflate. Still, most investors ignored these signals. They were too intoxicated to understand what the bartender was telling them to stop. European capital had also begun fleeing American markets weeks before the crash. Foreign investors, especially the British, saw U.S. stock prices reaching irrational levels. And when something rises without logic, its fall is just as inevitable. British banks quietly liquidated American stocks throughout September and October. When the crash finally came knocking, their money was already safe on the other side of the Atlantic. The signs were everywhere for those who knew how to read them. Margin calls had been increasing for weeks. When investors buy stocks with borrowed money and prices fall, they face margin calls. Brokers demand more cash or threaten to sell the stocks. By mid-October, brokerage firms were struggling to keep up with the volume of margin calls. Smart investors saw this as a warning sign. If people were already struggling to meet obligations in good times, what would happen when things turned bad? The answer was obvious to anyone who had lived through previous panics. Trading volumes also surged to unprecedented levels throughout October. To the public, this looked like enthusiasm. In reality, it was nothing but desperation and impending disaster. High volume often signals distribution by large investors. The transfer of company shares to small investors is a story as old as markets themselves. Professionals pass on a story they no longer believe to amateurs who still have hope. While those on the inside quietly exit, outsiders rush in with excitement. October 1929 was no exception. Even companies themselves were sending clear signals to anyone willing to look. Corporate executives were selling record amounts of their own shares throughout the year. If the people running the companies are selling, it means they know something the public doesn't, and they're doing something everyone else isn't. These were not ordinary sales. They were preparations for disaster. Smart money inside corporations was heading for the exit just as decisively as smart money outside. Perhaps the greatest speculator of his era, Jesse Livermore, had been preparing for catastrophe since early 1929. Livermore understood crowd psychology better than almost anyone alive. He had made fortunes by betting against consensus during previous panics. As 1929 progressed day by day, Livermore built massive short positions. He wasn't just avoiding the crash. He was positioning himself to profit from it. When stocks hit bottom, his bets against them would pay off. And they did, spectacularly. As the bells of the 1929 crisis began to ring in late October, Livermore was rubbing his hands in anticipation of the greatest profit of his life. The bond market had been flashing warning signals for months, like a fire siren. Normally, when stocks rise and investors abandon safe assets for risk, bond prices fall. But in late 1929, bonds began to strengthen even as stocks climbed. This divergence surprised many observers. In reality, it clearly showed that experienced investors were quietly moving money from speculation into safety. Even as headlines celebrated prosperity, they were preparing for trouble. International currency markets were also sounding alarms. The dollar had been strong throughout the 1920s, attracting foreign capital into U.S. markets. But by October 1929, subtle shifts showed confidence in the dollar beginning to crack. European central banks had already begun accumulating gold instead of dollars. This was a silent vote of no confidence in American financial stability. When central banks lose faith, private investors usually follow. Perhaps most revealing was how dangerously unstable the market structure had become. By 1929, nearly 50% of stock purchases were being made with borrowed money. Investment trusts of the 1920s were borrowing to buy stocks in an environment where other funds were also leveraged. This was leverage piled on leverage, a debt pyramid supporting inflated prices. Smart investors understood that when everyone is in debt and prices start to fall, selling becomes unstoppable. Forced liquidation feeds on itself until the entire structure collapses. Professionals had seen this pattern before. In other markets, other bubbles, other crashes. They knew financial gravity always reasserts itself in the end. If nothing supports what rises, it must eventually fall. The only question was timing. And by late October 1929, the timing was perfect. Smart investors weren't just leaving the market. They were positioning themselves to profit from the disaster they knew was coming. While newspaper headlines still proclaimed a new era of lasting prosperity, the real players, the ones who understood the game, were running very different calculations. They knew markets moved in cycles. Every inflated bubble eventually bursts. Leverage always demands payment. They had studied history, and history always repeats itself with ruthless precision. This was no surprise to them. It was the inevitable event they had expected from the beginning. The hours before the crash were filled with frantic phone calls, rushed meetings, and desperate attempts to salvage what could still be saved. But for those who had followed the warning signs, October 28th was not a day for panic. It was execution day. They had spent months preparing their strategies. Now it was time to apply them with surgical precision. On the morning of October 28th, trading opened under intense selling pressure. The Dow Jones Industrial Average had already fallen sharply the previous week, but most investors believed this was merely a correction in an unstoppable bull market. Smart investors knew better. This was just the beginning of the avalanche they had been waiting for. While amateur investors clung to their positions hoping for a rebound, professionals accelerated their exit strategies. Jesse Livermore was especially active during these critical hours. He had been building short positions for months, but on October 28th, he significantly increased his bets against the market. Livermore understood that panic selling feeds on itself. Margin calls force investors to sell stocks to raise cash. These forced sales push prices lower, triggering more margin calls and even more forced selling. It becomes a vicious cycle that destroys everything in its path. Livermore had positioned himself to profit from every step of this downward spiral. Telephone lines between Wall Street and the great mansions of Long Island were jammed with traffic. Wealthy families who had accumulated fortunes over decades were liquidating positions they had held for years. These were not speculative trades. They were moves to preserve generational wealth. Old money understood something new investors had forgotten. Markets can wipe out decades of gains in just days. It is better to sell too early than too late. European investors were also making their final moves in October. On October 28th, British and German banks that still held American securities were selling them at any price. They recognized the absurd rise of the American bubble and knew it was not normal. Transatlantic cables were nearly overwhelmed by a constant stream of sell orders from London, Paris, and Berlin. Foreign capital was leaving America as fast as 1929's communication systems allowed. Corporate executives faced their own moment of reckoning. Many had been compensated with stock options worth millions on paper, but only if they were exercised and sold before the collapse erased their value. Throughout October 28th, insiders were converting paper wealth into cash at a frantic pace. They knew their own businesses better than anyone and could see the disaster signals flashing across the entire economy. The Federal Reserve was also in motion, though its actions were more subtle. Central bankers met in emergency sessions throughout October to debate their response. Some argued for lowering interest rates to support markets. Others insisted speculation needed to be purged, even at the cost of short-term pain. While they debated, smart money wasn't waiting for government intervention. They acted on their own. Bernard Baruch spent October 28th calling his network of financial insiders. These conversations confirmed what he already suspected. The selling pressure was not coming from frightened small investors. It was coming from institutions, banks, and wealthy individuals who had decided the party was over. When big players move together, resistance becomes impossible. Commodity markets were also sending warning signals that smart money read carefully. Gold prices rose steadily throughout October, showing investors were seeking safe havens. Oil prices weakened as traders anticipated falling industrial demand. Farmers worried about their ability to finance the next planting season, putting agricultural commodities under pressure. These moves often precede stock market crashes by days or weeks. Investment trusts of the 1920s faced their own crisis. Many had borrowed heavily to boost returns during the bull market. Now, as prices fell, lenders issued margin calls. Fund managers faced an impossible choice: sell their best assets for cash or default and face collapse. Either option would accelerate the downturn. Smart money understood this dynamic and positioned itself to profit from the forced selling that would follow. Professional speculators weren't just betting against individual stocks. They were hedging entire sectors. Real estate companies, consumer stocks, and luxury goods manufacturers were prime targets. These professionals knew that during economic downturns, consumers cut non-essential spending first. The companies that thrived during boom years would suffer the most during the crash. Behind the scenes, the Federal Reserve continued to walk a tightrope. Some regional banks quietly tightened credit to reduce speculation without triggering panic. Others prepared emergency lending for banks that might face deposit runs. Insurance companies quietly adjusted their portfolios overnight, reducing equity exposure and increasing holdings of government bonds or hedges. Their moves were critical. They were among the largest institutional investors of the era. As October 29th approached, private banking relationships were tested. Wealthy families quietly moved assets to institutions they believed would survive the coming crisis. These were not just financial decisions. They were votes of confidence in management and business models. Smart investors were not merely protecting their wealth. They were aligning themselves with the financial institutions most likely to emerge stronger from chaos. Market psychology was shifting in ways only the most experienced could understand. While small investors still clung to hopes of a rebound, big players had already made their final moves. When the opening bell rang, Wall Street was shaken by a wave of selling it had never seen before. This was not panic. It was a calculated move by those who knew exactly where the system would break. Jesse Livermore was extremely active during these moments. As prices fell with gaps, he expanded his massive short positions. He knew that real profits don't come from the first drop, but from the acceleration, the moment when forced selling triggers more forced selling. He had studied panics throughout history and learned one truth: when leverage unwinds, selling breeds more selling, and eventually everything collapses. For more, follow Marcus.